So the market itself is de facto discounting 45% earnings growth this year, which has happened in the past. It's not a zero event. It's happened 3% at the time in the past. So call it a 1 in 30 event. But when you normally get a 45% earnings boom in a year, you're typically coming out of recession, let alone a soft landing, let alone possibly or probably heading into recession. So this market is, you got the analysts saying we're going to have a soft landing that's going to generate 11% growth in earnings. The stock market's saying how it's priced, never mind soft landing. The stock market's priced for an unremittent economic boom. So there you have it. Will a recession upset the apple cart? Of course it will. Again, under the premise that it actually happens. Like I said, it didn't happen last year in the most traditional sense, looking at GDP. And those other metrics I mentioned were flat. They weren't negative. However, you go from positive to flat. There's still the policy lags to kick in. Where do you go next? So I think that a recession is still my base case scenario. I'm not throwing in the towel, because if I threw in the towel in 2007, I would have looked like an idiot. And a lot of my counterparts on Wall Street look like idiots. People just tend to forget. And of course, if so long as you toe the line and, if you're a bear in a bull market, you'll be forgiven. I mean, if you're a bear in a bull market, you won't be forgiven. But you're a bull in a bear market, that's fine. Because these are the things people don't want to talk about. They don't want to think about. But if you're managing money for other people, you have a fiduciary responsibility to have a good idea as to where you are in the business cycle.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back David Rosenberg for a third time. So David is the founder and president of Rosenberg Research and Associates. So David, thanks so much for coming on the podcast today.
Well, thanks for the invite.
No problem. I'm looking forward to our conversation. So last time we spoke, it was sort of close to 6 months ago. And I know at the time, you thought it was very unlikely that we'd be able to get through the Fed hike. There was yield curve was inverted. There's lots of sort of negative, I guess, indicators that we were seeing. And then I think you said that you thought a recession was sort of going to come at least by end of Q1 2024. It doesn't seem like that has happened. So I guess from your perspective, what has changed? What has influenced that? And I guess why do you think the economy is sort of still going strong?
Well, I wouldn't characterize the U.S. economy as going strong at all. I think it comes down to a case of beauty being in the eyes of the beholder. We have discrepancies and dichotomies in the data that I have not seen in my 40 years in this business. We have, for example, 3.1% growth year over year in real GDP, and of course, that gets all the attention. But there's been no growth in the past year in real gross domestic income. The gap between the spending accounts, which is what GDP is, and the income accounts has never been this wide before. We've had no growth at all in the past year in industrial production. And while you can argue that non-farm payrolls have remained robust, of course, every single month of non-farm payrolls, the previous month is being revised lower. But we have 1.8% growth in non-farm payrolls, but only 0.4% growth in the household survey. That's equivalent in terms of differential of almost 2 million jobs. So I would just submit to the viewers that if the payroll survey looked like the household survey, and the household survey is running flat, and all the jobs in the past year in that survey has all been part-time. But if you were going to replace the payroll survey with household survey, and you're going to replace GDP with GDI, you'd come to a different conclusion about the shape of the U.S. economy right now.
Yeah, it makes sense. Is there a potential that, I guess, if we look back at 2008, post that, post the crash, it seemed like there was sort of a new economy, or it was a new way to look at how the economy works with QE, etc. Do you think there's something similar maybe that's occurred over the past few years, where maybe some of our other indicators, as you said, aren't showing exactly what's happening in the economy?
Look, the economy is always evolving. So, I don't think that is any different than all the talk about some new economy after we got out of the real estate mess in the early to mid 80s. Is it different than coming out of the tech wreck and mopping up all that excess capacity back in the early to mid 2000s, post great financial crisis? Of course, different sort of economy. It's always changing. So that argument doesn't impress me so much. What we have to try and grapple with is, why do we have such a big divide, especially in the national accounts? Production in the past year is flat. I don't know what sort of new economy that is, and that's even with the AI craze. Flat industrial production, and we have flat gross domestic income in real terms. People don't realize that profits in real terms, adjusted for inflation, are flat to negative. So flat production, flat real income, but real GDP over 3%, which is astounding. And that's the number everybody looks at, is GDP. What's GDP? GDP is spending. And I guess because we're just all a nation of narcissists, that we just focus on the spending side to gauge the economic health of the country. But production is flat on a 12-month basis, not a 1-month basis, not a 2 or 3 month. Over the past 12 months, production is flat. Real domestic income is flat, but real GDP is up over 3%. And the question is why? What's the difference? Well, the difference is this: production and income are not leveraged. GDP is spending, and that can be leveraged. And that's really what happened last year. Last year, in terms of explaining why GDP was so strong, came down to three things. We had the last leg of the excess savings file from the Biden stimulus checks that were mailed out to everybody, as long as you had a pulse, back in the winter of 2021. That was a gift that kept on giving. That was a $2 trillion gift that couldn't possibly be spent all at once. That had a lingering impact right through into last year. And then we had a credit card boom of virtually unprecedented proportions. It was astounding that you would have had double-digit growth in credit card balances at a time when interest rates on these things were well in excess of 20%. And now we're paying the piper, because you see that the delinquency rates on credit cards have gone up to the highest level since 2012, when the unemployment rate was 8%, not 3.9%. Very interesting. Massive credit card boom. The last leg of the excess savings drawdown, which frankly I wasn't expecting, because the research shows that when households in America are confronted with a stimulus check in the past, they used to spend half and save half, but didn't get saved. It all got spent. I did not think we'd finish the year with the savings rate flirting with around 3.5%. It's less than half the pre-COVID norm, but we become a nation of where acronyms are like YOLO. YOLO, you only live once. YOLO to Main Street is what FOMO is to Wall Street. And then the really big one was the expansion of fiscal policy. I mean, here we had the unemployment rate below 4%, and the government expanded the deficit by 25% last year. That is unheard of. But when you look at the fiscal expansion last year, both directly and indirectly, so indirectly, I'm referring to the multiplier impacts on the fiscal expansion, that accounted for 2/3 of that 3% GDP growth last year. And the other third came from the drawdown of the excess savings in the household sector and the spending associated with the credit card boom. So outside of these three developments, actually, GDP growth was flat, in line with production, in line with income. And people might say, well, that's data mining. I prefer to call it analysis, but only point it out because if I was an equity analyst and I was writing this up like a company report, I'd put an asterisk and I'd say at the bottom of the page, these are non-recurring items. Credit card rejection rates have gone up to near record highs. People are applying for fewer credit cards. And because the misery right now of having your FICO score affected by the fact that delinquency rates on credit cards have gone up to 12-year highs. And the excess savings file is now in the rearview mirror. And as far as fiscal policy is concerned, all we're doing is running fiscal policy right now on a set of continuing resolutions. There is no more fiscal stimulus until possibly after the November election. So you're just taking away the crutches that supported GDP growth last year. They gave you collectively 3 percentage points of growth. All the growth last year in GDP came from these sources, and they're not in existence anymore. And then you're searching for, well, what is the catalyst that's going to cause a reacceleration of the economy? I frankly can't really find one. And we could talk about the AI craze, but that's really a secular development. You know, the explosion of dot-coms and the internet and the World Wide Web didn't stop the economy from going into recession back in 2000, 2001. That's a secular shift in productivity, but not enough to stop the economy from embarking on an outright recession, which, by the way, I think is starting right now. I don't, my intention here is not to scare anybody. This is not a medical diagnosis. Recessions are part of the business cycle. It just so happens that nobody really likes to talk about them. And at the first opportunity, like you saw last year, economists will throw in the towel on the recession call when it doesn't happen, just like they did in 2000 and like they did in 2007. But delayed is not the same as derailed. And there were some leverage-related factors that kept GDP growth alive and well last year. But there's other components of the economy, like I said before, that are not ratifying that 3% GDP growth. And now the GDP growth is going to start, and it's already starting. It's going to start to revert to where that trend, that flat trend in real income and industrial production are right now.
Okay, makes sense. So then if we look at, I guess if I think about it, even if we enter a recession, do you see that having an impact on the market? Because it seems like at the moment, there isn't that real big catalyst. So if we look at 2008, obviously, mortgage-backed securities. If we look at 2000, there's massive bubble with all these companies not making money. You could say there's a bubble now, but most of these companies are actually making some money. 2020, it was COVID. So do you think there's that catalyst to actually have maybe a large market correction, or do you think maybe it's just going to be economic growth weakening, and then we're going to sort of go sideways for a while? What are your thoughts on that?
Well, I don't see that there's an asset class that's priced for a recession. And I would include commodities in there. I'd include corporate credit, high yield investment grade, and I include the equity market. Right now, everything is breathing the fumes of a soft landing, or some Wall Street analysts are calling it a no landing. So a recession will come as a very big surprise. The markets are not priced for a contraction in the economy, which would necessarily involve a contraction in earnings. The stock market right now is operating under really two beliefs. The first is that we have a consensus on Wall Street that we're going to have 11% earnings growth this year. Well, that will not happen if we have a recession. But when you're taking a look at the multiples, I mean, look at what is a normalized multiple in a 4 to 4.5% range on the 10-year Treasury note yield historically. So when you look at where the multiple should be based on past performance with interest rates where they are, we should have a 16 multiple as a fair value. This market's not a fair value. We're at a 21 multiple. So when you back that out, it's one thing to say, well, the analysts are calling for 11% earnings growth this year. But the stock market, not the analysts, the stock market is priced for 45% earnings growth. It's the only way you could make the current forward multiple make any sense against the backdrop of the interest rate landscape that we're in right now. If we were at 0 rates or 1% rates or even 1.5% rates, you could build the argument that the multiple should be inflated. But we have multiples right now that are trading as if the risk-free rate is back close to 0. No, it hasn't been 0 for over 2 years, 3 years. So the market itself is de facto discounting 45% earnings growth this year. which has happened in the past. It's not a zero event. It's happened 3% of the time in the past. So call it a 1 in 30 event. But when you normally get a 45% earnings boom in a year, you're typically coming out of recession, let alone a soft landing, let alone possibly or probably heading into recession. So this market is, you got the analysts saying we're going to have a soft landing that's going to generate 11% growth in earnings. The stock market's saying how it's priced, never mind soft landing. The stock market's priced for an unremittent economic boom. So there you have it. Will a recession upset the apple cart? Of course it will. Again, under the premise that it actually happens. Like I said, it didn't happen last year in the most traditional sense, looking at GDP. Uh, and those other metrics I mentioned were flat. They weren't negative. However, you go from positive to flat. There's still the policy lags to kick in. Where do you go next? So I think that a recession is still my base case scenario. I'm not throwing in the towel, because if I threw in the towel in 2007, I would have looked like an idiot. And a lot of my counterparts on Wall Street look like idiots. People just tend to forget. And of course, if so long as you toe the line, and if you're a bear in a bull market, you'll be forgiven. I mean, if you're a bear in a bull market, you won't be forgiven. But you're a bull in a bear market, that's fine. Because these are the things people don't want to talk about. They don't want to think about. But if you're managing money for other people, you have a fiduciary responsibility to have a good idea as to where you are in the business cycle. So, I think that looking at, never mind if we get an earnings recession, look where the multiple is right now. Look where the multiple is right now. The multiple of 21, forward multiple of 21. It was 18 this time last year. A 3-point multiple expansion in a 12-month span, that is a 1 in 10 event. Having a multiple of 21 is a 1 in 10 event. So I just don't think right now the tailwinds are with you. The math is not with you. An equity risk premium of 50 basis points, the math is not with you. If you want an equity risk premium that means as an equity investor you're going to get paid to take on the risk, go to Japan. Go to Japan. It's a $10 trillion market. It's totally liquid. And it has actually been radically outperforming the U.S. stock market, even with the weaker yen. So you want to go where there is value. I think Warren Buffett actually figured this out himself. I'm sure. But that's where I'd be heading to if I was going to be long equities.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, and as you say, Japan's been really benefiting over the past 12 months, really. I think some policy changes there in terms of, as you said, monetary, also, trying to be more shareholder conscious, I think,
Right.
rather than what they were as well. So that's been a really interesting market. Is there a lot of people I've been listening to have been saying maybe that higher interest rates are actually stimulatory, because, most of the people who have the assets and the cash are, I guess, in the top part of society. They don't have much debt, so they're basically just getting 5% cash paid to them for nothing. Some of these companies like Apple have hundreds of billions of dollars of cash as well. So their income's literally going up just from sitting there and doing nothing compared to what they used to. So do you sort of buy into that? And you could say the opposite as well, that the lower half of society have majority of the debt. So it's yeah, sounds like you don't.
Well, it's really quite funny. So I guess what you're saying is that to fight recessions, the Fed should raise rates, and to fight expansions, the Fed should cut rates. Like so to kill inflation and to say curb demand, you would be advocating that the Fed should cut interest rates because it'll lower interest income. Is that the logic?
Well, probably not cut rates, but it's actually maybe doesn't have as quick an effect on the economy as people expected, because there's so much, especially because there's so much US debt out there.
It's a
The Turkish
it,
president would love me
okay,
saying cut
it's
rates.
interesting. I got 100 years worth of data. Every recession followed a period of rising rates, and every expansion followed a period of reduction in rates. So now we're going to flip history around and say that because of this myopic view that you have companies or even households, you can argue the same. You can, households, look at the savings deposits, look at the money market funds, 5% plus. But these people, firstly, they're savers. They don't spend that money. There's nobody looks at the bank account and says, "Hey, honey, we're up $10,000 on our interest. Let's go spend it." They just, it's like dividend income. People might spend capital gains. That's the wealth effect. People do not spend interest income or dividend income. That gets reinvested. On top of that, we have to consider that what causes the recessions and causes the expansions is not necessarily just the impact of what interest rates do on interest income or interest expense. When the Fed raises interest rates, it makes it more costly to borrow money to finance a home or to finance a car purchase or furniture. And then that has all sorts of leakage impacts on the rest of the economy. People talk about services, but services service the goods producing side of the economy, which is usually the first to get hit because they're credit sensitive. So when the Fed raises interest rates, it makes it more expensive to borrow to spend. That impact on the economy is far greater than the impact it's going to have on interest income. And then when the Fed raises interest rates, what does it do to capital spending? Well, if you're a CEO or CFO of company X and you're embarking on a capital spending project, you're always looking at your a priori expected rate of return on capital benchmarked against the discount rate. Well, what happens when the discount rate goes up? Has a huge impact on capital spending intentions. So you can't take a look at something as complex as the US economy and say, well, higher interest rates are just great because it has this sort of impact on interest income. You have to take a look at the holistic interpretation of what's going on. As Albert Einstein famously said, the power of compound interest is the eighth wonder of the world. And it has all sorts of influences. But the overriding impact it has, why does the Fed cut rates? The Fed is not cutting rates in a recession with only thing on its mind about cutting interest expense. They're thinking about this will stimulate borrowing activity and it will stimulate spending activity because the cost of financing big ticket items has gone down. So this notion that you brought in front of me, which I've heard before, by the way, it's basically, a ridiculous notion that rising rates are good news for a credit-driven economy, and it doesn't mean that rising rates don't mean that savers benefit. They do. Um, you'd have to come back and say to me, well, this higher interest income is going to be used to work in the economy. that companies will take. I mean, you talk about the cash flow boost from their holding of financial assets. Well, what are they doing with that money? So let's say that company X, as you just said, is making more profits because of their financial holdings. Is that staying as part of their retained earnings? Is it staying, being stuck on their income statement, or is it being put to use in the real economy? So these are the things, people just say things that I don't know why, and then people don't even have a real comeback. But there's a reason why every recession was followed by a period of rising rates. And by the way, the traditional lag between the onset of the tightening cycle and the onset of the recession is 2 years. So the Fed first started raising rates in March of 2022, and we are now exactly 2 years later. And what do you know? Let's look at the first quarter. First quarter, housing starts are running negative 9.6% at an annual rate over the fourth quarter average with 1 month to go. Real retail sales are running negative so far in the first quarter, and so is industrial production. And that only happens in an economic expansion historically, 3% of the time. You're 12 times more likely to be in a recession when these three major indicators are going down in tandem in any given quarter: housing starts, industrial production, retail sales volumes. And I just finding so many people are living off last year's fourth quarter and not recognizing that the first quarter is looking totally different. The recession could actually be starting right now. And in fact, the data are telling me that.
So it's not about when. Oh, it's not about if, it's about when.
It's about that. I guess that those of us that were saying the recession was going to start last year, we were being impatient and tempestuous and not giving the lags enough time to work their way through. To be buying into an argument that higher rates is good for the economy is ludicrous. But there are lags, and as I said, what gave the it's the same thing in 2007. The lags took longer because households found a new valve. It was the last legs of the housing bubble, and what we called MEW back then. It wasn't YOLO. It was MEW, mortgage equity withdrawal, and cash out refinancings, and that kept the household sector alive and well up until it wasn't alive and well anymore, because the recession, as we know, started in December of 2007. The recession back then, nobody saw coming. We weren't calling it a Great Recession until after Lehman went down for the count in September of 08. But the recession started December of 07. Now, it just took longer for that cycle to play out. The Fed stopped tightening in the summer of 2006. And it just took longer to play out. This time around, it's taken longer to play out for the reasons that I suggested. So the fuse is longer this time, or maybe not longer. Like I said, the average lag is 2 years from the end of the tightening, from the beginning of the tightening to the recession, and 2 years is right now. But all I'm going to say is that don't be fooled. Do not be fooled. We have downward revisions to the data. That is very pro-cyclical. Downward revisions to retail sales, industrial production, 167,000 downward revisions to non-farm payrolls. I mean, seriously? I mean, people don't look at this and start to question the veracity of the data. But downward revisions are very pro-cyclical in the sense that when you're moving out of recession, the revisions are turning more positive. When you're going to recession, the revisions turn more negative. It's actually an excellent indicator. But I'm just looking at the facts in front of me. And I'm looking at the three cornerstones of the economy right now: production, retail sales, and housing. And they're all negative at the same time in the first quarter. And it's astounding to me that nobody's talking about it. I guess except for me. I think that, we run our own internal nowcast model, and it's not the St. Louis, it's not Atlanta Fed, not New York. Atlanta Fed, last I saw, was still north of 2% at an annual rate. I don't know how they get there. We have 80 variables, 80 macro inputs in our nowcast, and it's showing negative 1.4 for Q1. So I'll tell you, we get negative 1.4 for Q1 real GDP. Unless people just believe that's an aberration, the recession call from last year that was then thrown into the waste paper bucket by virtually every Wall Street economist, is going to come back into vogue in the second quarter.
Yeah, it's funny. The Atlanta Fed, as you said, they have had quite outlandish numbers, but they've actually been quite close to what GDP has been, from my understanding, over the past few quarters. So, do you think maybe there's something behind the method to their madness?
And look, there's a wide divide between. I mean, the New York Fed does theirs. The St. Louis Fed is actually, getting closer to our view. Atlanta, I can't look. I can't really explain how anybody can still be above zero on first quarter GDP. And we also have data on government spending. It's not being a supporter. We know that the trade balance is not going to be adding to growth. There's no offset really to what I just talked about. So I think that's a big risk. And then you'll get people coming out saying, yeah, well, we had negative quarter in GDP in early 2022. Don't worry about it so much. But back in early 2022, you also weren't seeing production flat and real gross domestic income flat. So it's all going to come together. All these numbers will ultimately converge. You'll have to make up your mind what's going to converge on what. Will production and incomes gravitate up to real GDP, or will real GDP gravitate down to those other two major components of the economy? Like I said, there's huge divergences, and beauty's in the eye of the beholder. What if non-farm payrolls begins to look like household employment is flat, pretty well flat, 0.4% in the past year? If non-farm payroll starts to look like the household survey, and like I said, GDP starts looking like GDI, and maybe you're right. Maybe we have a whole new stock market on our hands that it's just all about AI, and we're all going to just be discounting 30 years into the future, and we don't have to worry about the business cycle. Maybe the stock market's in a whole new era. But the one thing I do know is that the Fed will be singing like a canary and scrambling to cut interest rates. And so you can dream up any scenario you want. Maybe there's going to be Wall Street analysts that'll say, "Hey, look, this market fair value is a 30 multiple." You have all sorts of people talking about like they were back in the dot-coms, and it's not the same situation. But you get paid to be bullish on Wall Street, especially if you work at a big bank. You can't really, your masters won't let you turn bearish. So you dream up ways to justify the valuations of the market. But the one thing that I am comfortable in is that interest rates will be coming down. The yield curve's only been inverted 15% of the time in the past. I mean, it's been inverted now for, looks like for at least a year and a half. And it's only inverted 15% of the time in the past. This is a very abnormal state. So the yield curve will pivot, re-steepen. The Fed will be cutting rates, I believe, more than what the markets got priced in. And I think that treasuries will deliver out the curve a 20% return for this year. The bear market in bonds ended last October. It's not a straight line, but I think that rates are going to be coming down. And the best potential return, because of the duration exposure, will be at the long end of the treasury curve.
That was literally my next question. I was going to ask, what do you think the Fed should be doing? So do you think they should be cutting sort of at the next meeting, or what are your thoughts on that?
I was never a big fan of the view that they would go as early as March. But again, taking a feather out of the historical record cap, the Fed usually starts to cut rates 10 months after the last rate hike. And the last rate hike was last July, I always thought May would be the month. I still think May. You could argue June or July. I'm not going to chase nickels under the steamroller because timing this thing is not easy to do. But the Fed will be cutting rates, and sometime in the spring or the summer. And the question will be the speed and the magnitude. I don't think that they will stop before getting to neutral. They have not changed the rest of it of neutral. It's still 2.5%. So just to get to neutral, they'd have to cut rates almost 300 basis points. And the market's not even priced for that. And if we get a recession, it's going to be quite a bit more than that. Just remember the last 3 recessions, the funds rate got close to zero each time. And you can't rule that out. In a recession, the funds rate will come down a lot more. Soft landing, I think that they'll still come down between 200 and 300 basis points. So for me, this is like easy peasy. This is an easy call. They're not going to stop at 3 cuts. That's not going to happen. And then the question is going to be, how will the back end of the curve respond? How much will the curve steepen? And then to what extent will this breathe life back into the economy in 2025 and 2026?
Do you think, because I guess a lot of people are thinking that if the Fed start cutting, that's going to actually be a bullish scenario. Do you see that, or do you think that the economy is going to be going so bad that it's not going to be?
Well, it'll produce a knee-jerk positive reaction. So if you're trading the market, sure. The Greenspan came in on January 3rd. It was the first trading day of the year in 2001 and cut the funds rate intermeeting by 50 basis points. And I think the stock market was up 5% that day. Yeah, so you can trade the market. Did you want to go long in January of 2021, knowing that the market didn't actually bottom until September of 2003? I should say September 2002. No. So nothing was in a straight line. You'll get a pop. When the Fed cut the discount rate in the summer of 2007, the stock market surged. And did you want to buy the market for a trade or buy it for good, knowing that the market didn't bottom until March of 2009? So this is what happens. The market will trade off the rate cut. The market will believe that the Fed has saved the day, but invariably, the day will not be saved until the Fed cuts the funds rate sufficiently to steepen the yield curve enough to generate the economic recovery. And that's going to be some time away. So you'll get a tradable rally on a Fed rate cut, but it's a rally you'll rent but not want to own.
Yeah, it makes sense. And because you're saying sort of a lot of this is linked to, I guess, private debt, which has sort of helped with consumption, continuous consumption. So do you see this as being sort of an unwinding of, I guess, the private debt trend that we've been seeing, not just in the US and Canada and basically all the
Mhm.
countries? Or do you think it'll be more sort of like a slow burn, and then there'll be QE, or there'll be sort of bailouts coming out to support people? How do you see that going down?
Well, I don't know so much about bailouts. I think that you already had Jay Powell in 60 Minutes talk about that he's fully expecting that regional banks are going to go under and that there will be consolidation in the industry. Um, but what happens, there's no doubt that the private debt market has stepped into the void. That's something else that happened last year. I mean, it's a $1.5 trillion market now. I mean, it's equivalent to a third of the size of the regional banks in terms of the outstanding credit. But how long can that really last as credit quality erodes? Which is going to happen, and it already is happening. It's happening in automotive credit. It's happening in credit cards. You've had the private lenders, or say the private debt guys, certainly provide a strong antidote to the decline in lending amongst the banks. However, what happens when delinquency rates rise? And they're rising not so much in the mortgage market. Lightning doesn't strike twice. But the mortgage market and the market for automotive is not insignificant. And you are starting to see, by the way, mortgage delinquencies start to rise, albeit from very low levels. This creates a more cautious atmosphere. And this is all happening with the unemployment rate of 3.9%. You see, what happens in a recession is a recession leads to job loss. And what's interesting is that although you've been seeing that in the household survey, you're not seeing it yet in the non-farm payroll survey. But what companies have been doing in the non-farm payroll survey is they've been cutting the work week like it's nobody's business. So if you believe in the veracity of non-farm payrolls, notwithstanding the fact that every month we're seeing downward revisions, uh, employment's still going up, but the hours worked are going down, and you're down almost 34 hours on the work week, and you don't go much below that up until such time as companies have to start making tough decisions. They've been refraining from taking the tough decisions to lay off staff because of the miserable experience coming out of COVID. The economy reopens, and all of a sudden you couldn't find your former staffing anymore, and we had this huge labor demand supply mismatch. Wages skyrocketed for a while. Very painful period. And so companies are trying to avoid that, but we're down to rock bottom levels on the work week. What happens when you start to see the job loss? And what happens with job loss? With job loss, you get income impairment, and that's going to trigger another up leg in these delinquency rates. So if you're going to have private lenders stepping up to the plate to lend in a period where we're seeing impairment to credit quality, if I'm an investor, I want to be as far away from these lenders as I possibly can be. That's really not how capitalism works. Now, will there be bailouts? Invariably, probably if things get bad enough. The U.S. government has been known to, to bailed out the whole, basically, banking sector back in 2009. So it's quite possible. I could see the Fed having to be in a position where they might have to, and they might choke on doing this, but have to re-expand the balance sheet. All these things are not evident to the naked eye today, but I spend most of my time thinking about what are the headlines going to say 6 or 12 months from now. I'm not concerned about what the Wall Street Journal is going to be saying tomorrow. And I think that starting to see enough change at the margin. And once the employment picture cracks for good, these delinquency rates in the consumer space, wide swaths of the consumer space, which are already at 12-year highs, are going to go up more. And so, no, I don't think at that stage you're going to be able to say, oh, yeah, the middle market lender guys and the private debt guys and the shadow bank system is going to be there to bail out the economy. I don't think so. Will Uncle Sam be there to bail it out? Well, once again, it depends on how bad it gets. The big banks are well capitalized. I don't think there's going to be a run on the banks, or that, we're going to have a replay of 2008, 2009. But asking me about will there be bailouts, it depends on how bad things get. But the answer is that that's always a policy prescription for the U.S. government when things go awry. So you can't rule it out.
Yeah, okay, makes sense. So you mentioned that you sort of think that long end bonds are going to benefit, I guess, in 2024. Are those, you've also mentioned Japan, you think it could be a good market. Are those sort of the two places that you're currently looking at? Is there anywhere else that you think could benefit this year?
You're talking about in terms of the equity market?
Any markets, whatever you think.
Well, Treasury yields are amongst. I'm not going to throw Australia or Japan, Australia or New Zealand in there, but you taking a look at most countries in Europe. Look at France. Look at Germany. Look at Italy. Look at Greece. Treasury yields are above all those countries' yields. Look at the gilt market. The U.S. is trading at a premium to look at Canada. The U.S. Treasury market is trading at a significant yield premium. And it's not even the case. And although we are all freaking out over U.S. fiscal policy, the U.S. balance sheet's better than it is in other parts of the world, including Europe. And yet Treasury yields are higher. Of course, they're higher because the cost to carry is higher, with the funds rate pinned, between 5.25% and 5.5%. The Fed has done a lot more work than other central banks have. And there is no more important determinant of yields out the curve than expectations of the Fed, much more powerful than fiscal policy. People always say that, or I'm hearing people say, well, the Fed will cut, but long-term rates will go up. And I'm saying, well, what's the math behind that? Because what is a 10-year Treasury yield except a scrolled, compounded view as to where, say, 3-month yields are going to be rolling, or 2 years in the next 10 years. And then you have the term premium on top of that. But what happens in a recession is that, of course, fiscal deficit goes up, but what happens is that the household sector and the corporate sector turn into big net savers, and they deleverage their balance sheets in a recession because the private sector turns exceedingly cautious. They stop spending and they start saving, and that creates the vacuum for and the valve for the higher fiscal deficits. Every recession has seen the deficit go higher, but yet every recession has seen treasury yields go lower. I've never seen a period where the long end of the curve failed to make you money, and certainly outperform the stock market during periods when we have a recession, the Fed's cutting interest rates. So I would say my preferred debt market is the market for U.S. long-term treasuries. And, my favorite stock market that we talked about before is Japan, because Japan is going through, and you had mentioned that, a secular re-rating of their assets in a positive fashion. It's the last leg of Abenomics. And, as you said before, the move towards encouraging, nurturing, compelling companies to move their idle cash off their balance sheets to boost shareholder returns, that is massive. I mean, this re-rating reminds me a lot of what happened in the U.S. market back in the early 1980s. Because for decades, I don't know how to say the words in Japanese. I don't know how to say share buyback in Japanese. I don't know if you do. I don't know how to say dividend payouts in Japanese. However, what I can tell you is that for decades, those were oxymorons in the Japanese investment lexicon. And so shareholder returns, you look at the all-in yield of the Japanese stock market, and you look at the equity risk premium, and it's a very, very compelling situation. And I don't think that's changed. I could talk about India. India is seeing, again, Modi has implemented a wave of supply side measures. I'm very impressed. Now, notwithstanding some of the regulatory issues taking place right now, what other part of the planet is seeing 9% GDP growth and being fueled by capital spending? And that is leading to a productivity revolution. You look at the productivity numbers. In India. I mean, Ronald Reagan would be blushing over those. So those are investable parts of Asia that I like a lot. And within the equity market, those are my two favorite regions. They have been for a while. I'm not changing that view. Those are secular, not cyclical reasons to be involved in those markets. Like the U.S. Treasury market, the longer duration, the better, because I am squarely in the disinflation camp, notwithstanding the bump in the road that we've had in the past couple of months. I think that is actually transitory. And I like gold a lot. I like gold a lot because once the Fed starts cutting rates, I think people will be surprised how deep the rate cuts will be. The U.S. dollar will lose its overvalued status, and gold will be a nice refuge. I guess you could argue, well, what about Bitcoin? The issue with me and Bitcoin is just the degree of volatility. My audience and my clients don't have ice in their veins, and Bitcoin has 4 times the volatility that gold has. So I'm the sort of economist and strategist. I bunt for singles. I don't swing for the fences, because when you swing for the fences, you're going to strike out even as you hit home runs. That's not my style. So gold is also a very critical part of my recommendations.
Yeah, makes sense. Yeah, I think we're speaking on the 19th of March, and I think some cryptos down 10%, and then it sort of bounced back another 5. It's just, yeah, it's a very crazy market, as you said. And I think when we talk about Japan and share buybacks and certain distributions, it's just the fact that some of these companies, their market cap was less than the actual cash that they had in in their company. It's not the fact that capitalism gone mad. It's more the fact of just rebalancing what they were doing. I think because they went way too far to the extreme of cash preservation, and I think there's a nice balance somewhere in between there. But yeah, so David, thanks so much for coming on. I appreciate it. If anyone, so what is one message to people that you'd like people to take away from our conversation?
Right. Well, there's a couple of things I will first just say that I still carry the banner in these crazy times uh, of capital preservation and the preservation of cash flows and diversification. None of those have gone out of style. And anybody who is interested in what I produce, be happy to give any viewer on this call a 1 month free trial. And you can find me at information@rosenbergresearch.com.
Perfect. I'll put that on the description below. But yeah, David, thanks again for your time.
All the best, Anthony. Take care, everybody.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.